I want to quickly talk to you about IRS Form 4562 line by line instructions. Let's talk about depreciation and amortization rules. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's conversation, I want to talk to you about IRS Form 4562 line by line instructions, depreciation and amortization rules. Now, first, let me give you an overview of Form 4562. And we're showing you right now on the screen, we're going to show you important worksheets to have and concepts to understand when filing Form 4562. So we're showing you right now on the screen, we have Table A, General Depreciation System. This is for the double declining balance, the 200%. This is important to have in mind. Then you have Table B, the General Depreciation System. This is again, this is the accelerated depreciation system. So you have 150% declining balance, switching to straight lines. You can see this on the screen. It started as a declining balance DDB, and then it switches to SL, so straight line. And then we have here Table C, General Depreciation System. This is a straight line. So here you have the recovery period is 27.5 years, and the convention is mid-month. So you depreciate the asset by the 15th of the month. And Table D, here we have a general depreciation system, straight line also. The convention here is the mid-month, but the recovery period is 31.5 years, depending on the asset. And Table E, we have the general depreciation system, and the recovery period is 39 years, again, straight line and mid-month. So I'm showing you right now also the depreciation worksheet. This is very important, folks, and we actually lifted this from the IRS website. And if you need more info, go to www.irs.gov/instructions/I4562. Now, what is really new this year? You have a Section 179 deduction dollar limit. So right now, the maximum expense deduction for Section 179 is $1,040,000 and $1,075,000 for a qualified enterprise zone property. And this limit is reduced by the amounts by which the cost of Section 179 property placed in service during the tax year exceeds $2,590,000. And one thing you need to remember also is that the maximum Section 179 expense deduction for sport utility vehicles placed in service in tax years beginning in 2020 is $25,900. And so you want to use Form 4562 to claim your deduction for depreciation and amortization, to make the election under Section 179 to expense certain property, and provide information on the business investment use of automobiles and other listed property. And who must file this form? Now, you need to file if you're claiming any of the following: depreciation for property placed in service during the current tax year, a Section 179 expense deduction which may include a carryover from a previous year, depreciation on any vehicle or other listed property regardless of when it was placed in service, a deduction for any vehicle reported on a form other than Schedule C, Form 1040, profit or loss from business, any depreciation on a corporate income tax return other than Form 1120S, and amortization of cost that begins during the 2020 tax year. Now, when we talk about Form 4562, there are a few things there are a few concepts you need to have in mind. So those are depreciation. I mean, this is very simple. This is actually the annual deduction that allows you to recover the cost or other basis of your business or investment property over a certain number of years, right? This is the recovery period. And depreciation actually starts when you first use the property in your business or for the production of income. So depreciation ends when you either take the property out of service, deduct all of your depreciable cost or basis, or no longer use the property in your business or for the production of income. So generally, you can depreciate tangible property such as buildings, machinery, vehicles, furniture, and equipment, and intangible property such as patents, copyrights, and computer software. Now, the depreciation of intangible assets is called amortization. So you can depreciate tangible property, but you amortize intangible property. Remember though, you cannot depreciate land. This is very important to remember. And so another concept you need to be aware of is acres and makers. So acres stands for ACRS, stands for the Accelerated Cost Recovery System. This applies to property first used before 1987. And the makers, the modified accelerated cost recovery system is a current method of accelerated asset depreciation required by the tax code. So under makers, all assets are divided into classes which dictate the number of years over which an asset's cost will be recovered. And the cool thing here is that each maker's class has a predetermined schedule which determines the percentage of the asset's cost which is depreciated each year. And you have section 179 property, right? This is very important. And you also need to, there are a few things you need to remember though. There are some special rules for qualified section 179 real property. So you can elect to treat certain qualified property placed in service during the tax year as section 179. And make sure that the qualified improvement property as described in section 168E6 is applicable to you, and any of the following improvements to non-residential real property placed in service after the date of the non-residential real property was first placed in service. So things like roofs, heating, ventilation, and air conditioning property, fire protection, and alarm systems, and security systems, right? So this property is considered qualified section 179 real property. And so you have amortization. You also have the concept of a listed property. This is very important to remember. You have commuting. Now, generally, commuting is defined as a travel between your home and a work location. However, travel that meets any of the following conditions is not commuting. So you have at least one regular work location away from your home, and the travel is to a temporary work location in the same trade or business, regardless of the distance. And generally, a temporary work location is one where your employment is expected to last 1 year or less. And the travel is to a temporary work location outside the metropolitan area where you live and normally work. Your home is your principal place of business for purposes of deducting expenses for business use of your home, and the travel is to another work location in the same trade or business, regardless of whether that location is regular or temporary and regardless of distance. So those three scenarios are not considered commuting by the IRS. All right, now let me give you a Form 4562 line by line instructions. So here you have part 1. So this is election to expense certain property under section 179. So remember though, an estate or trust cannot make this election. So you can elect to expense part or all of the cost of section 179 property that you placed in service during the tax year and use predominantly, in other words, more than 50% in your trade or business. And however, for taxpayers other than a corporation, this election does not apply to any section 179 property you purchased and leased to others unless you manufactured or produced the property, or the term of the lease is less than 50% of the property's class life, and for the first 12 months after the property is transferred to the lessee, the deductions related to the property allowed to you as trade or business expenses, except of course rents and reimbursed amounts, are more than 15% of the rental income from the property. So here, line 2, you have to put the total cost of section 179 property. Line 3, you need to put the threshold. Line 4, you have to put the reduction in limitation, as I was talking earlier, by subtracting line 3 from line 2. Line 5, you have to put the dollar limitation for the tax year, and you need to subtract line 4 from line 1. If 0 or less, enter 0. And if married filing separately, you need to see the instructions of Form 4562 on the IRS website. And line 6, you have to put actually the required information. Line 7, you have listed property, right? So this is where you need to enter the amount from line 29. Line 8, this is the total elected cost of Section 179 property, and you get this amount by adding 6 and 7, lines 6 and 7. And line 9, you have the tentative deductions, so you need to enter the smaller of line 5 or line 8. And line 10 is a carryover of disallowed deductions from line 13 of your previous tax year's Form 4562. And line 11, this is pretty cool. This is called a business income limitation. So here you enter the smaller of business income, not less than 0, or line 5. And line 12, this is the Section 179 expense deduction. And line 13 is actually the carryover. And what I want to see here, and then you have part 2. What I want to see here is it's very important, and I want to show you something on the screen for lines 1, 2, 3. We're showing it right now on the screen. There is a maximum Section 179 limitation calculation. So we have a table here you can see here. And so you have, this is the limitation calculation. You see from 1 all the way through 8. And for line 1 of this worksheet, you need to enter the total amount of eligible Section 179 property, including qualified Section 179 real property, not just the amount for which you are making the election, because this is very important. And one thing I also want to say here is that line 12, and this is important, and this is for line 12 is the limitations on lines 5 and 11 apply to the taxpayer and not to each separate business or activity. Very important. I'll be right back right after this. Don't go anywhere. Welcome back, folks. We are still having a conversation here, line by line instructions, and I want to talk to you now about line 14. So you can see here, part 2, line 14, this is where you have to put the special depreciation allowance for a qualified property. And if you have the amount, you want to put that. Line 15, this is a property subject to Section 168, Section F and Section 1, F1. And line 16, if you have other depreciation, including acres, in other words, property that was placed in service before 1987, you want to put it here on line 16. And one thing I want to mention that's very important here is that and I want to show this to you right now in terms of part 3, actually. No, before I go to part 3, I want to go back to part 2. The line 16 is important because you want to enter the total depreciation you're claiming for the following types of property, except listed property and property subject to Section 168 F1 election. So you have acres property. So this is the pre-1987 rules, right? Property placed in service before 1981. Certain public utility property which does not meet certain normalization requirements. Certain property acquired from related persons. Property acquired in certain non-recognition transactions. Certain sound recordings, movies, and videotapes, and property depreciated under the income forecast method. And the use of the income forecast method is limited to motion picture films, videotapes, sound recordings, copyrights, books, and patents. And if you are interested more about this income forecast method, we can actually have an entire show focused on that. Just let us know in the comment section, and if we see popular demand, we'll certainly do that. And one thing I also need to mention here is that you can elect for any class of property to not deduct any special depreciation allowance for all such property in such class placed in service during the tax year. So to make an election, you need to attach a statement to your timely filed return, including extensions indicating the class of property for which you are making the election, and that for such class, you're not to claim any special depreciation allowance. And the election must be made separately, though, very important. It must be made separately by each person owning qualified property, for example, by the partnership, by the S corporation, or for each member of a consolidated group by the common parent of the group. This is very important. Let's go now to part 3, Maker's depreciation. Folks, we're still looking at the screen right now. We have Form 4562, and so basically here on so part 3, yeah, Maker's depreciation here. Now the term modified accelerated cost recovery system includes the general depreciation system and the alternative depreciation system, and generally Makers is used to depreciate any tangible property placed in service after 1986. However, Makers does not apply to films, videotapes, and sound recordings. All right. So on line 17A, you need to put the assets that are applicable to Makers here. And line 18, if you are electing to group any assets placed in service during the tax year into one or more general asset accounts, you want to check here. Okay. This is only important if you only check it if it applies to you. And here you have section B. So those are the assets placed in service during the current tax year using the general depreciation system. And section C, this is for the if you're using the alternative depreciation system. All right. So you can see you just have to put the month and year placed in service for the asset for each asset. The basis for depreciation, so you have the business investment use only, the recovery period, the number of years, aka the useful life of the asset, the convention, the method, whether straight line or double declining balance, and the depreciation deduction. And one thing I also want to mention, and this is very important here, is that you need to, there's something called a mid-month. So you have the mid-quarter, the half-year convention, the mid-quarter convention, and the mid-month convention. So half year basically means that, I mean, for you actually can depreciate every 6 months. And mid-quarter, you can actually depreciate. So mid-quarter, you actually depreciate in the middle of each quarter, and so on and so forth. And one thing that's very important here is that half-year convention does not apply to residential rental property, non-residential real property, and railroad gradings and tunnel bores. It treats all property placed in service or disposed of during any tax year as placed in service or disposed of on the midpoint of that tax year. So for that, you need to enter HY in column E. Okay, and for a mid-quarter convention, you need to enter MQ in column E, and for mid-month, you need to put MM in column E. So what else do we need to talk about here? This is very important. And one thing I also need to mention before moving on here is that you have something called Maker's recapture. So if you later dispose of property you depreciated using Makers, any gain on the disposition is generally recaptured, in other words, included in income as ordinary income up to the amount of the depreciation previously allowed or allowable for the property. And depreciation for this purpose includes any of the following amounts taken during the tax year. So any Section 179 expense deduction claimed on the property, any special depreciation allowance available for the property unless you elected not to claim it, and any deduction under Section 179B for capital cost incurred in complying with Environmental Protection Agency's sulfur regulations. Now let's move on to part 4. Now you can see here, part 4 is, you can see on the screen here, it's called summary. And so on line 21, you need to put the property, the listed property. All right. And you need to enter the amounts from line 28. And I'll talk about that line 28 later on. And so on line 22, this is the total. Now, a partnership, other than an electing large partnership or S corporation, does not include any Section 179 expense deduction here on line 12 on this line. Instead, any Section 179 expense deduction is passed through separately to the partners and shareholders on the appropriate line of their Schedule K1. We actually covered this subject extensively on our Schedule K1 line-by-line instructions particularly when it comes to depreciation data being passed on to partners. So you really want to go back to that show and watch it. So this is for line 22. And one thing I also want to see here, is that now let's talk about line 23 for part 4. Now, for if you are subject to the uniform capitalization rules of section 263A, you need to enter the increase in basis from cost you must capitalize. And the one thing that's very important here is that this is an important topic if it applies to you. So if you want a detailed discussions of who is subject to these rules, which cost must be capitalized, or allocation of cost among activities, you need to see regulations sections 1.1.263A-1. And so here on line 23, the amount that you put here will have an impact on the rest of the document. So you really want to be very careful here in terms of what kind of data you put here. And going back to what I said earlier about the recovery period really depends upon the asset, and it has an impact also on the line 23. Now let's talk about part 5, listed property. So listed property here, what is listed property? It's everything from cars, certain other vehicles, certain aircraft, and property used for entertainment, recreation, or amusement. Now, it's very important to note that for any vehicle for which you are using the standard mileage rate or deducting lease expense, you need to complete only 24A. We're showing this on to you on the screen right now, 24A, 24B, columns A through C of section A, all of section B, and section C if applicable. All right, we're showing this to you right now, the part 5. So if you claim the standard mileage rate, actual vehicle expenses, including depreciation or depreciation on other listed property, you must provide the information requested in part 5, regardless of the tax year the property was placed in service. However, if you file Form 2106, you need to report this information on that form and not in Part 5. Also, if you file Schedule C, Form 1040, and are claiming the standard mileage rate or actual vehicle expenses, except depreciation, and you're not required to file Form 4562 for any other reason, you need to report vehicle information in Part 4 of Schedule C and not on Form 4562. Okay, so this is kind of important here. And so one thing I need to mention here is that line 25, if you placed in service certain qualified listed property during the tax year, you may be able to deduct the special depreciation allowance, and this property includes certain aircraft acquired before September 28, 2017 and placed in service before January 1st, 2021, and certain qualified property acquired after September 27, 2017 and placed in service before January 1st, 2027. And another thing that I need to talk about here is that there's something called qualified business use. And this is an important element to explain here. And to determine whether to use line 26 or line 27 to report your listed property, you must first determine the percentage of qualified business use for each property. Generally, a qualified business use is any use in your trade or business. However, it does not include any of the following. So investment use, leasing the property to a 5% owner or related person, the use of the property as compensation for services performed by the 5% owner or related person, the use of the property as compensation for services by any person who is not a 5% owner or related person, unless an amount is included in that person's income for the use of the property, and if required, income tax was withheld on that amount. So this is very important to show, and I want to show you right now on the screen. You can see here there are actually a few tables that you might find interesting. So we have here table 1, so the limits for passenger automobiles, and then we have table 2. This is for passenger automobiles, including trucks and vans, acquired after September 27, 2017. We're showing you on the screen right now. Table 3, we have you can see on the screen here. Table 4, limits for trucks and vans placed in service after 2002 and before 2018. You can see it here on the screen. All right, I want to talk to you now about Part 5, amortization. As I said earlier, amortization applies to intangible property. So you depreciate tangible assets and you amortize intangible assets. That's just the one-on-one of this distinction here, amortization versus depreciation. And so if you amortize property, the part you amortize does not qualify for the Section 179 expense deduction or for depreciation. Okay, and so each year you can deduct part of certain capital costs over a fixed period. So we have line 42 here on the screen. So line 42, you need to complete this only for those costs you amortize for which the amortization period begins during your tax year. All right, so you have geological and geophysical expenditures. This is section 167H. You have pollution control facilities. That's the 169. You have bond premium, section 171. You have research and experimental expenditures, section 174. You have the cost of acquiring a lease, section 178. You have qualified forestation and reforestation cost, section 194. You have optional write-off of certain tax preferences over the period specified in section 59E. And you have certain section 170, 197 intangibles. So the following cost must be amortized over 15 years, in other words, 180 months, starting with the later of the month the intangibles were acquired, or the month the trade or business or activity engaged in for the production of income begins. So you have goodwill, the going concern value, the workforce in place, business books and records, operating systems, and any other information base, a patent, copyright, formula, process, design, pattern, know-how, format, or similar item, a customer-based intangible, for example, composition of market or a market share, a supplier-based intangible, a license, permit, or other right granted by a governmental unit, a covenant not to compete entered into in connection with the acquisition of a business, a franchise, trademark, or trade name, including renewals. And a longer period may apply to Section 197 intangibles leased under a lease agreement entered into after March 12, 2004 to a tax-exempt organization, governmental unit, or foreign person or entity other than a partnership. And another thing that's very important to understand here is that if you so we are here on line so line 43, you have amortization of costs that began before your 2020 tax year. And line 44, this is where you add amounts in column F. And another thing I want to quickly say here is that you have, you can, for startup and organizational cost, you can actually amortize the following cost. You have the business startup cost, the organizational cost for a corporation, and the organizational cost for a partnership. You can also amortize the creative property cost. This is important to know. And what else do we need to mention here? Yeah, on line 44, you need to report the total amortization, including the allowable portion of forestation or reforestation amortization on the applicable other deductions or other expenses line of your return. All right, folks. This was it for today's conversation. This was IRS Form 4562, line-by-line instructions. And I just basically, just to kind of quickly recap here, I gave you an overview of Form 4562, the important worksheets to have and concept to understand before filing, the key definition related to Form 4562. So you have depreciation, amortization, the exceptions, the acres, the makers, Section 179 property, the listed property, commuting, AMT, and record keeping. And I gave you on actually the line-by-line instructions. There are 5 parts. Actually, there are 6 parts for Form 4562. You have Part 1, election to expense certain property. Part 2, special depreciation allowance. Part 3, makers depreciation. Part 4, summary. Part 5, listed property. And Part 6, amortization. Thank you so much for your attention. Really appreciate it. I'll see you next time. But until then, remember, stay marvelous.